And listen, welcome along, everyone. Thanks very much for coming along to this ATC information session, Algorithmic Trading Certificate information session. What are the things that we're going to be taking you through today? I'll just very briefly go through them. First of all, to introduce Nick Ferruzzi and Brian Healy, who are the two lead faculty members, and they'll be taking you through the bulk of this presentation. They'll also introduce themselves a little bit to let you know what their backgrounds are and so on, especially in relation to algo trading. We'll be talking about the time commitment of this program. We'll be talking about the goals of this program, what the objectives are. We'll be breaking down the syllabus in a lot of detail. You can ask questions as we're taking you through the presentation as well. We'll be talking about who this program is for, how this program is assessed, the programming languages, the final project, what happens during the program insofar as how applied this program is concerned, how practical it is. And I should have also said my name is Jeff Brown, and I am responsible for everything that is not to do with the content of the program. So I'll leave you in Nick and Brian's hands with regards to all the content. Anything not to do with content, any questions about that, let me know. Nick, Brian, over to you guys.
Great. Well, thanks very much, Jeff. And let me just go here. Okay. Brian, you can share the screen.
Coming up.
Okay. I guess what we should do is first introduce ourselves. So my name is Nick Ferruzzi, and Brian Healy, my colleague, and I have been teaching this class, the ATC certificate, for now. This is our third cohort. But prior to this, I've been teaching algorithmic trading for some time, and I guess my background was that I started it at Lehman Brothers in 1994. I've worked at Lehman, Goldman, a number of large investment banks, primarily doing quantitative methods. I used to be a mathematician before, quantitative methods applied to markets. And it's much more recently, I'd say from 2013 onwards, that I got specifically involved in purely systematic trading, first of all in a QIS desk, and subsequently in hedge funds and investment banks. Since 2017, I've been teaching a course at UCL. Initially, it was a PhD reading course, and then eventually a master's course. It now has 120 students in it this last term. We cover sort of an academic perspective on algorithmic trading. As I say, it's in tremendous demand, but we try to gear people up for industry practice. Now there are some shortcomings in that course, because from my perspective, because we're unable to really delve deep into industry practice, and that's what this course is really attempting to do. I don't know what's on the next slide. Actually, Brian, maybe you can. Oh, there we go. Oh, there we go. Okay, so following the course, maybe Brian, maybe I'll let you continue.
And introduce myself. So Nick has said most of it, really. My background is quite similar to Nick. I'm also a mathematician. I've worked in financial markets for about 25 years. I guess the difference is I started off more of a kind of traditional quantitative analyst, and I was a trader for many years in a variety of investment banks, mainly in options, derivatives, etc. During that time, I got interested in quantitative trading, algorithmic trading as a way of improving my own trading, but also creating what are now called QIS, or quantitative investment strategies or solutions, which are really just automating good ideas, ideally for generating alpha. And since 2012, I've been a consultant to a variety of different entities, large and small hedge funds, private equity, tech companies, etc., and all kind of really around the financial mathematics kind of intersection, if you like. I'm also an academic, so I also teach at UCL in a different course to Nick. And there I do mainly machine learning, again, applied to financial markets. And I also I've done quite a bit of teaching elsewhere as well, in Stanford and NYU in the US and in Dublin and so on. So quite similar to Nick, really. There's no need to belabor the point. Do you want to talk about algorithmic trading, Nick?
Sure. So just as an intro to algorithmic trading, first of all, algorithmic trading is a broad term for trading which relies on mathematical models and algorithms. I'd say any way any way to automate large trades as markets have become more automated and increasing large volumes are executed using algorithms. That could be e-trading, could be automated execution. And I say many exchanges are now dominated by high frequency market makers with increased volume and speed leading to higher returns. Now, algorithms are used for in all aspects of the business, from high frequency to low frequency, trade decisions, portfolio allocations, and in placing orders. It needn't be that all aspects of an algorithmic trading process are done algorithmically at the same time. So some quant hedge funds are heavily algorithmic from the start, while others deploy algorithms as one element of their approach. For instance, there are many that will do algorithmic decision making, but the trading still has to be voice trading. And some shops automate the entire process, and I'm ahead of myself here, some only parts of it.
Yeah.
So Brian, why don't you carry on?
Sure. So this course is aimed at a variety of different audiences. First and foremost, we're targeting discretionary traders and risk managers. So these are essentially people who are working in the industry, either for large institutions or perhaps for themselves or for smaller entities, who understand kind of a lot about how the market works, but they want new tools to apply to new ways of making money, new ways of managing risks, etc., or just want to understand what people mean by algorithmic trading and how it might be affecting their business, etc. We're also focused on, or we also aim this course, I guess, really at people who are currently actually in algo trading. So there's enough detail in here that if you're currently in the area or working in the area or quite familiar with algorithmic trading, you might even be a quant from a more mathematical background. Then again, this is for you, because we focus very practically on how these strategies are implemented, who uses them. So we give you a really good overview of the different types of strategy, what can go wrong, etc. So we don't just focus purely on the mathematics, some of which you may already know. Maybe you trade a particular type of algorithm already, but want to learn more about the different alternatives. So we cater to all that as well. And we look at the technology and data issues as well that are faced by everybody in the area. And then finally, and perhaps in some ways, most obviously, those who are students or graduate or any level really, who want to learn about algo trading, learn about quant trading, and master the theory. We give all the references to useful papers, books, etc. Anything that will kind of supplement what we teach in the course, and you get a very good overview of how the whole area works, and how, I guess, how to kind of think in the way that an algorithmic trader does, I guess is what I'm trying to say.
Well, I mean, one of the things is that, since it's a very broad area, we believe one of the important things we do is give sort of a head start, and also give references, because there's a lot of areas that you can dive much more deeply into, and we like to sort of set you up to do so. So there's ongoing live discussions about that, how one should go about researching certain areas. And I think it's a very exciting area because all these new developments in an ongoing basis. So we like to highlight some of the new research.
Yeah. So you've heard all this already.
Yeah, covered a lot of that.
We'll spare you the details again. Do you want to go to the goals of the course, Nick?
Sure. So the goals, basically, we'd like to provide students with strong foundation algorithmic trading, including tools and techniques currently used in the industry. It's and I say commonly used, but as well those that are newly being developed. And students will learn about data sources, how to find alphas, how to do research on alphas, how to test a strategy, and how to optimize execution. And to give students the opportunity to apply what they learn in a hands-on project throughout the course. So we give a hands-on project. We do increasingly give more exercises and more background material as a way of sort of familiarizing yourself with it. By the end, these students should be able to build something that's an efficient, scalable models with consistent and testable performance. And I'd say that based on the final projects that students have submitted, that there's some very, very high quality work has been done. Of course, there's always more work that one can do, but I'd say that it's very possible to take our course and then to really sort of set yourself in the right direction for how to pursue developing new strategies.
Yeah, and I think it's probably at this point as well we should say, because it won't really be in the deck, because it's quite a recent development, that we are putting together a GitHub repo and a wiki for the course, where we're just gathering together all of these things, because even Nick and I forget where half this stuff is. So, to keep it current, to keep it to keep all the relevant stuff in one place, both from a code-based perspective and from a literature and documents and links to all sorts of resources, where that will all be available. And I think as well, and Jeff can correct me if I'm wrong, but if you do the certificate, you actually retain access to the material for, if not an infinite period of time, but quite a long period of time. So it's not, it doesn't just come to an abrupt end when the course ends. And we would hope, and we can't expect, but we would hope that course participants will continue to perhaps contribute to the GitHub repo and contribute to the ongoing development of the material.
Sure, and Brian, you're right. So for anybody who enrolls onto this program, you'll have access to all future ATC programs. So whenever there are syllabus changes, you'll have access to those as well. And just in response to you, Nikolaus, we can, well, if you can send, if you can let us know your email addresses, for those of you who want to have a copy of the slide deck at the end of the session, then I can do that. I can send that through to you.
Perfect. Thanks, Jeff. So, this relates to Nick's UCL course, so I'll let him explain. He kind of touched on it already.
Yeah, so as I said, it's I've been teaching the course. Okay, it's I said 2017 before. Initially, I did a course in 2016, and essentially it was that I was in the process of I was doing a systematic trading while at Nomura, realizing that there was an abundant amount of academic literature around this. It was possible to actually produce some academic coursework based on that without having to rely on divulging trade secrets. So Since then, the course has grown. As I say, it's one term every year. We've had over 500 students in the UCL course, as well as various different online versions of it previously. Now, unlike the UCL course, this is meant to be a hands-on approach to building trading pipelines, to gathering data, creating features, putting features into feature stores, modeling, modeling and forecasting, and then doing allocation based on allocation and potentially execution based on that. And then performance and risk management. So it should be one single pipeline, or with many large components to it, guiding the students through the common practices as well as potential areas of innovation. And this is a mistake here. It's not the second cohort. We're on the third cohort now. Initially we started at 8 weeks, recognizing that there was too much material for 8 weeks. We've now expanded to 12 weeks.
Yeah, I will make a few amendments to the deck before we send it on, including the syllabus, which you'll see in a moment. We're going to go through a different document which contains the most recent update to the syllabus.
Cool.
So at this point, I will stop that share. Apologies. And do you want to start off, Nick?
Sure. So to begin with, we start kind of easy. The first week would be an intro to the course, intro to types of trading and trading strategies. What is a trading strategy, and what is algo trading, both as an undertaking and as an industry? The industry is growing, it's diverse, there's lots of different segments of it. So we'll talk about the growth of the different subsegments, the growth of the funds under management, and the various different approaches to algo trading, because there are different strands of thought about it, and we'd like to give you an idea about the breadth of them, so you're not just focused on your own narrow field. Then secondly,
go on, Nick.
Okay, so secondly, we covered data sources. Where are decent sources for the data? Unfortunately, an awful lot of them are paid sources, so like the Bloombergs and the Reuters. But then there are also increasingly cheaper sources where one can find very good data. We discussed data, how to process data, the regular. Not ELT, but ETL method, sorry, it's ELT method, not ETL. The new ETL method, and then we cover the data sources for all the different areas, for futures, commodities, equities, fixed income, and how you can create features out of these data sources, what you can do, what sort of processing you need to do in order to do so. So features is in. We create, we do the data cleaning, the data imputation, removing outliers, but as well things like the basis of where do you store your features when you're done with them? Because some of the best practices in algo trading are borrowed effectively from ML ops, from machine learning ops, and feature stores are a big thing for them.
So then in week 3 we look at statistics and time series. So everything we do in this area relies heavily on statistics and a good understanding of the basics and how the basics are applied specifically to time series data, because of course financial markets, the sort of data we're dealing with for the most part is time series, and time series have their own issues and their own techniques for dealing with them. We look at asset prices as a particular form of time series, things like compounding, log returns, etc. And Then we go through the kind of the distributions that we commonly encounter. So many of you will know that the normal log normal distribution is often assumed, but there are others and we need to know them. Multivariate distributions. So how do you go from like the univariate to the bivariate to the multivariate, and how do we work with things like covariances and correlations, etc., and matrices. And specifically then on time series, there are important issues like stationarity. So in finance, unfortunately, things are rarely stationary, but we need to understand how to make things stationary and how trends work and what an integrated model is. We then look at things like autoregressive and moving average processes, which many of you will have come across at some point, but we need to understand those in quite a lot of detail in order to be able to understand differencing, how we go about making things stationary, and then later on in the course we'll be very dependent on, measures of stationarity and co-integration, etc. The final bit there is on forecasting and maximum likelihood estimation, which is a very broad tool that's used throughout statistics. So a lot of the methods that are used in developing strategies and optimizing strategies are kind of variations on MLE. Can you do machine learning, Nick, or shall I?
Why don't you continue?
Sure. And then in machine learning, we look at, first of all, again, a little bit of the fundamentals of what do we mean by machine learning, what's supervised, unsupervised, the different types of jobs that machine learning can do for us, such as clustering, classification, regression. And we sort of describe these very, very briefly, understandably, because we just don't have time to go into all of the details on all of these methods. What we emphasize is how they are used in algorithmic trading, obviously. So what we're particularly concerned with are methods that have broad applicability in algo trading, such as kernels, for instance, being something that many of you may not have come across before, or, well, actually you probably have, but you may not be aware of it. And they're very flexible, very useful tools. And things like neural networks and random forests are there sort of partly because they're popular, they're widely used. They have kind of a niche. They have niches within algorithmic trading, I would say, where they're useful. A lot of them are not broadly useful across all the different applications, but they do have their uses, and so we give you what you need to learn to know there. And then there's a specific emphasis on reinforcement learning, really as a way of motivating the whole idea of state action value functions and the Bellman equation and those sort of optimizations where you train using a sort of a reward approach. And so by the end of that, you will really have a good idea of how these methods are used across the piece in algo trading.
Yeah, and I'm going to say that one of the challenges, of course, in algo trading is that I say, unlike a lot of the areas where machine learning has been very, very successfully applied, algo trading, because in particular because of having a low signal to noise ratios and very, very and non-stationary data, despite our emphasis in trying to make it stationary, things, coefficients wander, coefficients change abruptly, and so as a consequence, it limits some of the applicability and it's an area of a vast research emphasis is when can you apply and how can you adjust machine learning methods to apply specifically to algo trading.
Yes.
Then I'll be covering the area of trend following. So there are various different strategies. You could say strategies in some sense, or there are features as well, because trend following is something we could do as a strategy in and of itself, but we can add trend specific features to models. And as a trading strategy, there's some very interesting behavior, and it's actually it's a subsector of the business is trend following funds, or CTAs, and we'll discuss those. We'll discuss How come trend following has continued to work? What are the properties of trend following? With the momentum, the the skewness related to it, and how that changes. How it's one of the few positively skewed strategies with a positive risk premium, and then the trade-off between and responsiveness and costs associated with trend following. We'll talk about the difference between cross-sectional of trend following, which is used by the large equities houses. So the AQRs of the world and the BlackRocks of the world, they tend to have cross-sectional momentum as one of the things they trade in terms of equity portfolios, but they're quite different when it's time series momentum. And then we'll talk about and then we'll touch on getting together a futures data set specifically for that purpose.
Great. And then another huge class of again, to use where strategies are carry strategies and volatility strategies. And carry it's a strange word in finance, and that I think everybody in the kind of industry uses it quite a lot, but I think a lot of people would struggle to actually define it sometimes. So we spend a little bit of time explaining the origins of carry, particularly in the foreign exchange context, where it arises quite mathematically and quite nicely. And then hopefully that will give you a really good understanding of carry. And so you will recognize it when you meet it. We then look at some of the specific kind of carry type trades. Obviously, we just mentioned the FX one, but there is carry in swaps and carry in futures and carry all over the place, really. So a lot of, in the same way the momentum kind of gets, overlaid or bundled in along with a lot of other strategies and a lot of other approaches. Similarly, carry is very frequently there too. So having anything which has a positive carry is always very desirable, and people spend a lot of time looking for it. It's worth then spending part of this section on something slightly more technical to do with measures. So this is sort of probability and the difference between the physical measure, which is the sort of measure we see all around us and sort of everyday life, the probability of an event happening, the probability of the market going up tomorrow, etc., versus the risk neutral world or risk neutral measure, which is used particularly in options pricing. And that world, and we emphasize how implied vol and realized vol are different. They're related but different things. That leads then to risk premia and volatility strategies. So a lot of volatility strategies are very much linked to this difference between the real observed realized volatility and the volatility from the options market. And we look at some of the different option strategies, long, short, etc. We look at volatility regimes and how volatility is typically modeled. So some of you may have heard of Garch type models, been around for quite a while. They were originally applied a lot to volatility, but there are other more recent models that we look at as well, because forecasting volatility is in a sense actually easier than forecasting the drift, right? So the change in the stock price or the commodity price, etc. So a lot of very fruitful effort actually has been spent on volatility forecasting specifically. And it's also of particular use, as we'll see later, actually with all strategies, but particularly for risk management. So when you're trying to risk manage any strategy or risk manage any business, being able to control your volatility forecasted is of paramount importance. So Nick, do you want to do mean reversion?
Sure. So then after the discussion on volatility strategies, we'll discuss mean reversion strategies. It's kind of a counterpart to momentum strategies. So discuss what is mean reversion, how do you test for it, many different tests for mean reversion, and what are the properties of them, and why even bother with statistical tests. To be honest, there's the statistical criteria, but then there's the reality of actually trading it. Then we'll talk about probably the most significant aspect of mean reversion is co-integration. So what is co-integration? Why does it matter? Where does co-integration happen? How do you test for co-integration? Co-integration is the basis for pretty much every relative value strategy out there for pairs trading in equities. There's a lot of trading that goes on which is based on co-integration. And so we'll talk about how do you implement mean reversion strategies, give you examples of them, and then also discuss mean reversion as and how it's related to market making, because in fact mean reversion returns and liquidity provision are actually relatively similar. And they may be at different time scales, but there's actually quite a lot of it's effectively providing liquidity to the market. Finally, we'll talk about when mean reversion stops working. How can we detect it? How can we detect it quickly enough so that we can get out of a trade and try to regroup and go on again? So there's many different methods for change point detection. Then applications to pairs trading and application statistical arbitrage, and as well factor models, which again, they're based on a PCA is based on looking for factors which are effectively trends, and then the higher order components, which are effectively the mean reverting components.
Yeah. Then you would want to do it, Nick? Go ahead.
No, why don't you go ahead?
Sure. So next up is features, factors, and forecasts, which is it's in some ways a bit of a recap on some of the things we touched on in the data section. So, data is obviously paramount importance to everything we're doing here. So any strategy development or really anything in this area requires data, sometimes a lot of data, sometimes less. But how you actually extract features from that and how you deal with particularly things like missing data, which can seem like in some ways a bit of a simple issue, but actually particularly when you're dealing with higher and higher frequency data, or you're getting into slightly more illiquid assets, it suddenly becomes a huge issue, right? There's suddenly a lot of missing data. There's suddenly a need to decide what to do when you have missing data, and how you deal with that can impact your strategies. You got to be very careful that how you deal with missing data doesn't in fact introduce a signal or introduce a bias or something into your data. Nick is editing.
Oh, I'm sorry.
That's all right.
No.
The other issue, which is common to all statistics, data, etc., is the issue of outliers. So how do we define an outlier? How do we spot an outlier? And what do we do, right? Because outliers may be a real part of the data, and by removing them, you may actually be losing information, and you may in fact be introducing some sort of bias as well. Having done all of that, and however you deal with all of these issues, you're going to have to store your data, you're going to have to process your data. So there's all tech issues around all of that. Different asset classes have different quirks, features, annoyances, frankly, that you need to deal with. And there are some decent quant packages out there, some good repos, some good libraries that are available, some free, which actually do help with a lot of these things. And then we deal with signals, and the signal again is a kind of a broad term. Typically we combine signals into a strategy, roughly speaking, but signals come in all sorts of shapes and sizes, some of them from technical features like the history of the price, some of them from things like carry, from factors. And again, we come back to this factors topic, which kind of crops up again and again, particularly when you're dealing with equities. So there's the kind of canonical asset pricing models like CAPM, APT, which we'll just touch on purely because you need to know them as sort of a framework in which to discuss more complex models in equities. There's a new factor everyday inequities. So it seems, so there is this kind of concept of a factor zoo, and we look at, you know, how that has arisen and how you deal with that. There are issues around, you know, with features and with creating signals from, you know, from data. Multiple hypothesis testing, or p-hacking, and there's different sort of data mining, lots of different terms for the same thing, is a real issue, and you've got to, you know, be aware of it, and, you know, have a strategy for finding alphas, we'll say, which avoids it for them, you know, as much as possible. Right. Then we will look at a very useful tool, principal components, which is used for dimension reduction. So rather than dealing with, if you've got features, 50 or 100 features, maybe that can actually be represented with 10 kind of components. And there's mathematical approaches for doing that, for essentially reducing the complexity of your feature space. Regularization is used pretty much always now as a matter of rote, particularly with machine learning type models, where it's essentially a way of taking a model which seems to work pretty well and making it a bit more generalizable, making it a bit more robust, making sure that it's not overfitted too dramatically. So it's kind of just kind of a very useful, almost like an overlay to your modeling. Double descent and adaptive filters, etc. I could actually probably let Nick talk about that.
Those are my, I guess I'd say, my favorite areas. So as Brian was saying, regularization used all the time. It's kind of a modern method in statistics and borrowed in everything in machine learning. Also, it's a way of avoiding having to do model selection per se, because you can just add a regularization term and ensure sparsity. So regularization is used frequently. Now, an area where regularization is not used is an area called double descent, and this is one of the reasons why machine learning why deep neural nets have such good generalization is because they have so many parameters in them. In fact, there's explorations as to exactly why they work, they generalize well, and one of the methods of exploring has to do with looking at this overparameterization, and it even works in the case of linear models or in very shallow neural nets for two-level deep neural nets. And so we look at very, very wide two-level deep neural nets as a way of forecasting with nonlinearity. And it's a way of doing PCA-OLS. The more features you put in, the more irregularized it becomes. These can be seen to be a form of adaptive filtering, and adaptive filtering is used primarily in signal processing, but also in mid-frequency trading and high-frequency trading, Kalman filters and recursively squares. Those are done on a regular basis. Then we look at and I think some areas have crept in from the previous section here, but we'll look at forecasting versus allocation, because the question is, what should we optimize? Should we optimize the mean squared error, the MAPE? What sort of measures should we look at? Because we're eventually going to want to take this and make a decision rule out of it, decide how much you want to go long or short a given asset. I guess then why don't we just skip ahead to section 9? So,
of relevance to all trading, of course, is actual execution. So you can have a great strategy on paper, or even with sort of real trading, real money behind it. But when you try and scale it up, or when you try and do it with a more meaningful amount of money, or perhaps across many different asset classes, then you suddenly run into these issues of, broadly market structure, market microstructure. How do you actually execute? Is it a quote-driven market, an order-driven market? Is it an exchange? Is it over the counter? So there's the obvious things like that. But a lot of algorithmic trading actually originally grew out of execution rather than anything else. So it was essentially a way of reducing execution costs by executing, say, large trades in a smoother manner. So rather than just going to the market to execute a huge buy order, you would slice it up into smaller orders, you would disperse it across different markets, you would execute it slowly, etc. And all of that can be put together as an algo to sort of to solve, to in real time optimize the execution. Nowadays we have things they're called agency algorithms very often. So depending on how the nature of your business, if you are a large entity, you will certainly be using some sort of prime broker or some sort of third party for your execution. They will have algorithms which will do your execution for you in a hopefully smart manner. You've obviously got proprietary algorithms, which are your own in-house algorithms for execution, etc. And a paramount interest is trading costs. That's really the focus of all of this, is how to reduce the cost of trading your book, executing or implementing your strategy. So we look at the different order types, and we look at some of the effects that they have on the market, when you would use them, how you would use them, etc. And then we get on to this really important issue of market impact. So if I execute a certain amount of a certain stock or a certain commodity, how far will the market move as a result? So obviously, if I execute a huge order, then the market is likely to move quite far. But in advance, of course, you don't know precisely how far it will move. So there's all of these approaches to modeling what will happen, these price impact models and market impact models. So we look at some of them. We also look at ways of minimizing your impact, which is clearly the name of the game as far as we're concerned. And then we move on to look at the related issue of market making, because pretty much no matter what you're doing, particularly if you're working, say, for a fund, on the other side of a lot of your trades will be sort of the market makers in whatever product it is. And they are essentially like mean reversion traders. They do well when the market kind of bounces back and forth, and they can, buy low, sell high, and make the spread all the time. So how their whole business model is very much dependent on the order book, how the order book evolves, the dynamics of it, the sort of market impact. And there are issues for them like market selection, how they manage their inventory, etc. So we go into all of that because in order to really understand how the market works and how the order book works, you really need to understand how essentially the guys on the other side work. You want to do portfolio theory, Nick?
Sure. So then the following week, week 10, is on portfolio theory and allocation. And essentially, portfolio theory is a sort of a concerted way for taking forecasts and so forecasts for the returns, taking the forecast for the risk, and some estimate of trading cost, trading impact, and coming up with optimal portfolios. So we'll look at it. We mentioned before CAPM and APT and FAMA French as sort of as places where portfolio theory comes into play. But then we'll talk also about how risk is modeled by FAMA French portfolios as well as other sorts of factors. Then we'll get deep into mean variance optimization. So optimal portfolio theory. And broadening it to include transaction costs, looking at simple 2-asset portfolios to n-asset portfolios, things like optimizing the Sharpe ratio, and then all the different equivalent formulations of it. Then we'll look at adding, say, transaction costs, and then thinking of this as a whole as just a form of quadratic programming. So quadratic programming is actually a very well studied area of mathematics, and we'll look at how these optimizing your portfolio based on risk constraints. So for instance, there could be risk constraints on, some sort of sort of allocation constraint. There could be a budget constraint. There can be some net risk constraints, some net allocation constraint, and maybe a gross allocation constraint. And each of these can be modeled in terms of this quadratic programming, but the underlying quadratic programs involve huge matrices, very, very, very cumbersome matrices. So we'll also talk about methods that are commonly used for actually doing that automatically using symbolic programming. We'll also talk about tactical asset allocation, updating your allocation on a regular basis, and mean variance optimization as regression. So it's how people can look at stabilizing the results of mean variance optimization. Then the following week we look at actually putting it all together, and so we generated strategies. How do you measure them? So because there's no one view for how to measure them. Everyone talks about a Sharpe ratio, but Sharpe ratio isn't necessarily the only way of measuring a strategy. There's the Sortino ratio, there's the Kalmar, the Omega tail ratio. There's a whole bunch of other of measures of portfolios, and what will performance. And what we'll see is that none of them is actually perfect. And in fact, I'd say that they're all kind of they're variations on an eyeball test, and none of them is as good as an eyeball. The problem is your eyeballs can't be used for everything. We'll look at analyzing drawdowns, like what could be the worst case scenario, and how can we present that to managers, to investors, so that they're aware of the potential downside before they get involved in the trade. We'll look at value at risk, and then putting it all together in terms of creating a realistic backtest. How do you create a realistic backtest in terms of putting your forecast together with the either the mean variance optimizer or some other method for creating allocations, taking those allocations and then testing the performance of the resulting trades, and how that's all put together. Finally, we'll look at optimizing hyperparameters, and this is an area that's a bit more artsy because oftentimes if you try to just purely optimize them, you go off and find some corner solution. But we'll talk about how one goes about doing optimization and tune your algos to get them so that they give the results that you're looking for.
Great, thanks, Nick. And in the final week, then we look at risk management, which, albeit it's the final week, it's not kind of an afterthought or sort of like the last bit like stuck on at the end. It goes at the end partly because it covers a little bit of everything that's gone before. It's related to everything that's gone before. So you can't really do anything in this space without understanding risk or how you're going to manage the risk. So, Nick, when you mentioned the sort of the constraints in the kind of optimizing strategies, it's these can be quite complex optimizations in risk management. You can be dealing with, if you're looking across an entire firm where there are multiple different strategies, each of which involve multiple different signals combined in multiple different ways, lots of different underlying assets. You're dealing with very, very complex data. So some of the major issues with risk management are actually how to work with big matrices, right? So big, complex matrices, cubes, higher dimensional objects, which tensors, which are not nice, but are sort of the bread and butter really of risk management. We'll break it down into sort of the linear and non-linear products, so sort of those, options versus not option type products, and how to kind of expand out your risk using things like Taylor expansions, how to decompose risk into the underlyings. We mentioned operational risk. It's not the focus of the course, to be honest, but it is really important for any fund because your investors, believe it or not, will be much more concerned with your procedures and policies around operational risk than they will be around anything else. You might think, oh, it's all about performance, and it's actually not. The investors are more worried about getting their money back than they are about return. So return is obviously desirable and nice, and Sharpe ratios and all are great. But if you're going to lose, if you're going to blow all their money because of some operational error, that concerns them a lot more. So that's, you know, really important one to bear in mind for anybody going into the industry who's not already in it. We then look at sort of some of the kind of the characteristics of various funds and how they're correlated with each other, or indeed not correlated in certain cases, and the sort of risks at a macro level almost that they're exposed to typically. We look at governance, which again could be related to operational risk too, but how you actually, you know, set limits, like things like leverage, things like, you know, concentration risk to different asset classes and so on. So there's different kind of crude, you know, governance things that can be put in place to really act like constraints then on the portfolio allocation. And scaling then for strategies is, you know, a huge issue with any kind of investment. Is you have a great idea, you think it's got a great return, it's back tested really well, but how much money do you put into it, right? How much of your capital do you put behind this one idea? Or if you've got 5 different ideas, right, and you've back tested them all and they're all good in various different ways, how do you decide to allocate between them, and how much leverage do you use? And there's different kind of models, approaches that are useful here. But, you know, back to kind of what Nick was saying really about sort of the eyeball. I mean, a lot of it does ultimately come down to a portfolio manager or a sort of a chief risk officer sort of deciding that, you know, here's a dollar number or a euro number that we're going to stick to until proved wrong. Value at risk, or VAR, many of you will have come across, but there are many kind of extensions of it, which, again, good and bad, a bit like the performance measurements. There are pros and cons to all of them. There's no perfect measure, but it's good to appreciate the shortcomings right before it's too late, obviously. And then finally we go back again to factors. So just to finish off, when we look at how you estimate covariance and how you shrink covariance measures, to sort of a technical term for smoothing out outliers in a sense, right? So you've estimated your covariance from data, and your data is only, you know, one observation from potentially, you know, huge population. So it will contain outliers in a sense. And so shrinkage is a way of kind of avoiding some of those problems. And then PCA again, which is a very useful tool actually generally in risk. So it's a really useful way of viewing the risks in a portfolio. So that's it in terms of the syllabus. I'll just go back to.
There are some questions coming through as well.
Yeah.
I think Stefan Krug has got a couple of questions, first of all.
Sure. Do you want to deal with those, Nick, and I'll just fire up the end of the presentation here?
Sure. Is it, it's not in the chat, right?
It is, yeah. So it's slightly further up the chat. The first question begins, question on data handling, outliers, missing data.
Oh, there we go. Oh, sorry, I didn't look. Yeah, question on data, outliers, missing data. How would you deal with implied volatilities for options you could receive from options? So, so of course we can get options data from Bloomberg. That's absolutely true. But so how would we deal with them? I mean, it's possible. Sometimes it's quoted in implied vol, and sometimes it's quoted in prices. There are conventions for this. But there are outliers in particular in regard to implied vol. Okay, so I'm going to say that I oftentimes have dealt with implied vol that's been maybe you could say pre-cleaned, which is but obviously if you have data from the futures market, so options on futures, you're going to have all the different calls, all the different puts, and there may be something that's sort of out of whack there. And so that's the so okay. I would say that there are standard methods in regard to the time series itself, but as well there's methods in regard to its relationship to neighboring time series, right? Because in similar thing in fixed income in the yield curve, you have a bond. Maybe you can look at the bond's price in and of itself, but how is it rich or cheap in regard to its neighbors, and is that significantly different? Because you don't necessarily want kinks in your yield curve. Similarly, in your vol surface, you don't necessarily want spikes in it. So there I'd say relatively there's some heuristic methods around that, but it's not necessarily that we're fitting a parametric model to the shape of the vol surface. I don't know, Brian, do you have differences? Do you think it's important to fit parametric models to vol surfaces?
I think, I mean, if you're doing out of the money stuff or with low open interest, then yes. I mean, you can, generally for the more at the money and for the larger, more liquid underlyings, the volatilities are fairly reliable in Bloomberg. It's more when you get into low delta stuff that you can have, and it's
Sure.
the option in the open interest is a very good guide. If the zero open interest,
Right.
it could be, it could nearly be anything. It almost has no meaning.
Right. And the thing is I'm sure it'll be that there has to be some sort of there shouldn't be a change of curvature, for instance.
Well, there are
shape of the
arbitrage. Yeah, I mean, there are arbitrage
And
constraints as well, right? In the extreme case, right? You have to. There are definitely binding arbitrage constraints, but Bloomberg will have applied those. But when you get deep out of the money, you can still, because the premium doesn't change very much for a given change in implied vol, you can have really wacky implied vols.
Right.
So yeah, you sometimes end up fitting something more like a spline or something parametric to bring things into line.
I mean, certainly, if you're working in another possibility is using a Sabre model or something like that, or a Heston model, that fits the entire surface just with a few parameters.
Correct.
So question on quadratic programming and optimization. I'm using scenario generation for IFRS 9 and found it time consuming. I always thought that algorithmic trading is about computing as fast as possible. So it depends. I mean, some algorithmic trading can be on a 1 day, rebalance once a day with a 1 day horizon or a multiple day horizon. Sometimes it can be intraday. Now, intraday, but not necessarily high frequency. Intraday, you can still do your QP. You can do it like 20 times a day easily, trivially. You could do it 50 times a day, trivially, because some of these QP problems are just incredibly simple, and there are ways to speed them up as well. Now, if it's high frequency, of course, you're probably not using quadratic programming. You're probably allocating and when it comes to reallocating capital between strategies, that may take place on a slower basis. But deciding how much to go long or short, no, I'm sure that's not a quadratic programming point of view. So really it depends on the time scale. I think it's crucial to know about these things because it's crucial to know about what you can do in which time scales. Stam had a question about risk management. How are counterparty and credit risk management? So I guess okay, there's two sort of aspects of counterparty risk management versus credit risk management. Brian, I'd take. I don't want to misstate this, but I think we don't really consider counterparty risk so greatly. Counterparty risk would take place when you have, if you're you versus an exchange. Okay, it's not such a big deal if it's a highly capitalized, highly regulated exchange like a CBOT or something like that, or CME. It might be a big deal if it's you facing a crypto exchange.
Yeah.
Because then there is a lot of counterparty risk. Um, but we're not going to talk about counterparty risk as in you are facing a swap counterparty. That's a slightly different matter, and it probably would take place at a firm level anyway. Credit risk is the from our perspective, I think is primarily looking at concentration risk. Credit risk is, I'd say each of these is actually quite a broad area and an interesting area of study, but something we can't go into in vast levels of detail at the same time. Brian, do you want to add to that?
No, I mean, I just to say though that credit as an asset class, as it were, is something that is becoming a bit more amenable to algo trading. So historically, credit trading didn't have much algo trading. It's more manual, on the phone, sort of discretionary type trading, for the simple reason that it's quite illiquid. It's not, exchange traded. It doesn't have a lot of the features that lend themselves very well to algo trading. But increasingly, there is more, in the corporate bond space. There's enough. There's a lot of corporate bonds that are like more liquid than a lot of governments. So, increasingly there is more focus on, and it's something we do touch on a little. Credit risk, as in, as to counter of really it's a counterparty risk for a fund, is something that, as Nick rightly said, it would be dealt with at the firm level. Your concentration with the given counterparty, failure of the counterparty to pay, and generally you're dealing with exchanges and clearing houses, so a lot of it kind of goes away. But we can certainly give the references to, I know a lot about it, so we can certainly provide you with what you need, but it's not something we focus on.
Yeah. And I guess even then, when it comes to credit trading is a very growing area. Credit trading itself, I'm going to say that surprisingly not a significant amount of concern for credit risk. I mean, maybe in terms of the limits they set, but it's really all about finding appropriate curves at different for senior unsubordinated and for subordinated debt, in terms of curves for the different all the different the major companies, and looking at them within a sector, and then typically it's making markets in each of these and seeing what the impact effectively of a move in one bond in one area is relative to the rest of the area. It's really fascinating because it remains highly illiquid. The kind of projects, the project that we have, okay, actually this is something that's important. So maybe what we'll do is we'll cover the prerequisites and assessment, and then we'll answer that question, hopefully.
Do you want to kick off, Nick?
Sure, please.
So the prerequisites that we've specified for the course are, you should be certainly an intermediate programmer. So we don't teach you the basics of Python, for instance. So you will need to know them or learn them before you can really engage with the course. Statistics or econometrics or statistical machine learning. So we do use statistical concepts. We do cover some statistics too, but we do them relatively quickly, and we do them relatively focused on the topics we're going to be talking about. So we're not going to give you a kind of a big introduction to statistics. Similarly for machine learning, you don't need to know the machine learning, I suggest, maybe before the course, but if you come from that background, you will have the statistics as well, and that will be absolutely beneficial. So it's more the statistics here that we're kind of emphasizing, I think, really, rather than the econometrics or the machine learning. And Definitely basic finance and familiarity with economics does help. So that's mainly in terms of terminology, jargon, expressions, the way we talk about things. So we don't again have the time to go through a sort of a glossary of every single financial term and explain what each of them means. We can point you in the right direction if you need to, but it really would help if you're kind of familiar with the basic terms. A plus is some familiarity with stochastic differential equations or differential equations. And this is because in a lot of the stuff we're dealing with, at the advanced end is clearly stochastic, right? We're talking about a real-time world where things are constantly changing. So the sort of models that we're discussing, even if we don't go into them in huge depths in the course, we will give you references, etc., which will allow you to go in and learn all about those things. So that would be beneficial, but not a must. And Nick can do the assessment.
Okay, so the assessment is going to be it's a PDF and Python notebook. We've done Colab notebooks describing a strategy in detail, its behavior, the rationale for the strategy, implementation and performance. Now, it doesn't have to be your best strategy, but it has to be one that is sensible and reasonable and I'd say well explored. And as well as looking at in terms of the limitations and room for improvements, because every strategy we know has some limitations. And every analysis has some limitations, and being aware of them allows you to know where you might have shortcomings, but as well where you can grow and improve. Now, the marks are for sensibility of coverage and exposition, for following the methodology, and for giving a good presentation effectively. And the goal is actually essentially to come up with what seems a sensible strategy and then to effectively justify it. There was one more before we wrap up. There was one last question by Kishle.
Yeah.
Who says, can we use these quant strategies for our own trading if we have market data from the exchange directly or through a broker provided API? And I'd say that yes. In fact, there is some of our students in other cohorts are specifically interested in that. Now, there's going to be limitations. There's some things that you can that it's easy for retail to trade that are not so easy for so they're easy for institutions to trade. They're not so easy for retail to trade, and vice versa. But certainly the basic concepts are always going to be the same. So yes, definitely many of these things. The goal is to be able to do them exactly as well through an API directly for yourself. Okay.
Yep. Should we wrap up?
Sure.
So as we said already, I guess that algorithmic trading is a large and very important part of the financial landscape nowadays, and we've mentioned how it's spreading into new asset classes, new areas all the time. It's becoming bigger and more important, and more of the volume across all financial markets are being traded with no human intervention, on a sort of day-to-day basis. So this is an area that's only going to grow in importance, and it's exciting, and it's fast. It's also changing quite a lot, which is why the course, even in the third cohort, has already changed quite a lot. It's not covered very well by universities. I mean, some of the aspects of it, I think, like there are obviously, you can do statistics in university, you can do econometrics, you can do machine learning, but there's very few. There's no overall course, I would suggest, that really does this well.
Except sort of my course, but
well, I'm thinking of your course more as a module, though, within a course.
It is. It's and it's actually surprising that this is sort of such an important area because there's a whole industry based on this, but it's not, but little in terms of academic preparation for it. So I think that's I think that's something will change over coming years.
Yes. And yeah, again, to emphasize that, the algorithmic trading practitioner's guide to this certificate is aimed to give you the practical skills. Most importantly, you will learn the theory, you will have the repo, you will have the the wiki and the slides and us to answer questions and so on. But actually, what's most important is just to get your hands dirty, build a strategy if you haven't done so already, and see how the issues that we discuss kind of play out with real data. So I guess we've already run over, so I'll thank you there, Nick.
Yeah. So thank you very much, and thank you for your questions. And well, I hope we've given a reasonable sort of background to what you should expect.
Just to add, if for those of you who do want a copy of the slide deck, I've put my email address, jeff@wbstraining.com. What I will also do, in fact, I need to just mention that there is a 20% discount at the moment extended for anybody who enrolls onto the program, which begins on the 10th of June. The 20% discount is available until Friday, 26th of April. So next, in 9 days time or so. Igor, thank you for your email address. Suraj, thank you for your email address as well. And what I'll do in terms of the enrollment form, to give you an idea, anybody incidentally who is self-funded through the program does not need to pay VAT, okay? Or anybody who is not in the UK or Europe, you do not need to pay VAT. And so Suraj and Igor, so yeah, apologies. Anybody who would like a copy of the slide deck, just either send me an email or put your email address in the chat, and I'll get a copy of the slide deck to everybody tomorrow.
Tomorrow, yeah.
And in the meantime, I hope you've all found this really useful and informative and enjoyable. And I think we'll call it a day there. And again, any questions at all, feel free to come through to me.
So,
Thank you all.
okay, thank you. Thank you very much.